Good morning and good afternoon, everyone. It is October 23rd, Thursday. Welcome to Morgan Stanley Asia Macro Webcast. My name is Crystal G, Asian EM Market Strategist. Before we start today, please note that this event is for Morgan Stanley institutional clients and financial advisors only. It is not for members of the press. If you are a member of the press, please log off and reach out separately. Please also note that this webcast and your questions may be recorded. Today we have Jun Suk, South Korea Equity Strategist and Head of Korea Financial Research, Sho Nakazawa, Japan Equity Strategist, Calvin Pang, Head of Asia Credit Strategy, Simon Jin, Asia Quant Strategist. During this session, you can send us questions at any time from the Ask a Question text box. This year, Kospi has taken off since Liberation Day, and it was even stronger in the recent month. Today, you have June on board with us, and then he has recently revised up the targets, and he continued to see upside potential from the structural growth drivers with the top-down reform agenda. So, June, can you talk about how do you evaluate the risk reward from now on?
Yes, thank you very much, Crystal. I think just touched 3,900 and just down a bit, but it seems like Dr. Kospi's personality has changed somewhat. Usually, it's an early cycle indicator for the EM a strong EM market. But and this is because of its cyclical tendencies. But it seems like Dr. Kospi is now showing a bit of a stronger structural growth platform. Our target for Kospi is at 3,800, and it's reached beyond that obviously. And our bull case is 4,200, and we do lean more to our bull case at this point rather than our bear case. And just want to first kind of touch on the trade tension issues between U.S. and Korea. Obviously, on the tariffs, there's negotiations going on right now. On October 16th, there was a hint by Secretary Besant that a finalization of the trade deal with Korea may come in the next 10 days. There is increasing news flow right now about a deal, and it seems like rather than a swap, it's just a structural, changing the structure of the deal where it could be kind of divided into a multi-year kind of a payment. And so we're waiting on that, but it seems like there has been some progress there, and it does seem to be reflected in the share price somewhat. Now, I think what's more important though is I think the structural growth stories that we're seeing here, and we're talking about the AI diffusion, which kind of links into the power generation and also the nuclear story. Then you have the defense and also the K culture of super cycles, and this is overlaid by this the drive on the capital market and the corporate governance side, which is actually also progressing quite well. And we are still waiting for the dividend tax reform and also the treasury share mandatory cancellation issues to be ironed out. So just kind of going to the secular kind of super cycles that we're seeing in Korea. So on the AI diffusion side, I think the story obviously is about all the investments that's taking place in terms of the infrastructure side, and the expectation for the data centers globally is around 2.9 trillion won, and that is being financed through various channels. But in terms of the growth, then obviously this is a positive for the Korean chip names because of the HBM demand also going up. But I think more importantly is that it's spreading to the commodity chip side, such as NAND and also DRAM. So, Sean, our analyst for the tech sector, has a constructive view on the memory cycle, and generally, it lasts for around 4 to 6 quarters. So he thinks that we're still in early to kind of mid innings for the NAND and the DRAM cycle. And when you look at the pricing data that's been coming out for both DRAM and NAND, it seems that there is going to be a sharp, kind of upward climb heading into the fourth quarter. So it does seem like the tech story is still quite intact, and there is more upside. And just on the power generation, we've kind of had a positive view on that, and it's again largely driven by the fact that these data centers need to have a lot more power, and we've been kind of positive on the fitting side and also the suppliers of the kind of the materials that's needed and also the wires. So that story seems to be continuing on. And then there's also the nuclear story. Obviously, share prices have gone up quite a bit, but when you do look at the story, it is still a secular story, which is playing out. And if there is going to be a build out by the U.S. In terms of the nuclear plants, which includes both SMR and the 1.4 gigawatt, then Korea is well placed because obviously we're one of the Doosan Enerbility is kind of the outsource maker of the power plants itself. And then you have the EPC players, which include Samsung, CNT. Also, Hyundai E&C has a contract with Westinghouse. So it seems like the nuclear story is something that's still developing, and we do need to see the orders come in. On the defense side, we are, there was a bit of a lull here, and the share price is corrected. Really was kind of linked to two factors. One was the ceasefire that we're seeing in the Middle East, and also the other factor is going to be about the concerns about the rare earth. After that, we've actually seen Hana Aerospace make a comeback in terms of share price. We believe that irrespective of how these kind of conflicts play out, we do think that reinforcement demand and probably more importantly, the replacement demand is actually going to lead to more new orders going forward. And at this juncture, it does seem like land systems is where there is more demand. And we do think that Eastern Europe, Middle East, and even moving into kind of the developing or the traditional strongholds is something that we also expect. And that's the same thing also for the Korea Aerospace, where it is also potentially going to make inroads into the more developed markets. But I think we're also going to see, the Middle East being a key market here. So the defense story still seems quite intact here. And kind of moving on to the reform side, this week we saw, another news that was quite positive, which is that not only for individual stocks, but also for investment funds, the dividend tax reform or the new measures would also be applied. So if a fund has more than 60% of its AUM in these dividends, high dividend stocks, then there will also be a break on the comprehensive financial income tax. So that's a very interesting, interesting development here. But in terms of the dividend tax reform, the one area where we're waiting for more clarity is on the top bracket, whether it's going to be a 35% rate or it's going to be 25%. And, we've been kind of thinking that the base case would be below 30%. And I think the market is also kind of looking on that side. And just on the Treasury share cancellation, we're still waiting for confirmation there, but it seems like it's going to take a bit more time because of the fact that we are also going to see, a bit of a conversation between what the grace period should be and also the criteria of the Treasury share cancellation. So I think at the end of the day, I think we're seeing that this is not really a if situation, but more of a how and when. So the timing is more the issue than whether it's going to get done. So I think the understanding and the commitment is there from the government side regarding this whole reform. And we do think that it's going to go forward. And we prefer the dividend stocks and the self-help stories and the kind of restructuring stories here. So we've been kind of sticking to securities, banks, autos, and the laggard holdcos. And also, activism is another, story that's building up with recently LG Chem having an activist fund kind of asking for more kind of positive movement on the capital management and also the governance side. So something to look for going forward. And just to finish up, in terms of the cycle side, we're still in the recovery phase, and whether we're going to get into the expansionary phase really depends, a lot on the secular, but also the cyclical recovery, and which is going to be linked more to the U.S. market. And it's something that we're kind of waiting to see. Notably, after second quarter earnings, we saw actually consensus earnings being revised up. And a lot of it was from the tech sector, but we do need to see this breadth actually kind of expanding to be a bit more kind of positive on the cyclical pickup here. So just to, on our sectors, we're positive on the industrials. We're also positive on the tech side. We also do like the non-bank financials, but also staples where we're kind of looking at the export names there. So let me stop there and hand it back to Crystal.
Thank you so much, June. Before you log off, actually, we have a very quick question for you. There is a client asking whether the China rare earth restriction will have any potential downside impact to the Korean chip makers.
Well, I think this is going to be an impact to all the sectors, which includes probably defense, chip makers, and everyone on how it plays out. It really, I think, is going to be more dependent on how the negotiations with U.S. and China kind of plays out, because that kind of probably drills in also. So in terms of the impact, I mean, obviously, if there is going to be a rare earth restriction, then there's also going to be a hit on, I think, the chip makers, but also defense and also probably even the power side. So in terms of, I think, the potential for impact, there could be there, but then again, semiconductors is needed across, all the regions right now, even China, the US. So whether they can actually do that and not impact the semiconductor supply chain is something that will have to be considered. So I think in terms of the chip makers, I would say that it's a very, very kind of has a broad impact. So whether that actually plays out, we'll have to see. But again, I think a bit better than maybe some of the other sectors that could be more impacted.
Thank you, June. I don't see any other questions on Korea, so you may log off now. Thank you so much for joining us. Thanks. And then next, we are shifting to Korea. Takaichi-san has been elected the first female PM in Japan. Today we have Sho here as well, and then he continues to be bullish on Japan. Can you talk a little bit more about the drivers behind the Japan market?
Sure. Thank you, Crystal. Takaichi-san has become Japan's first female prime minister, a historic turning point in Japanese politics, in my sense. Since the inauguration of the Takaichi administration, I've received two main questions from domestic and international investors over the past week. So the first is, will her leadership lead to expansion in index valuations? And the second is the administration committed to governance reform or not? And in our view, the answer to both is yes. With the inauguration of the Takaichi administration, we expect growth expectations to rise while the cost of capital declines, creating upward pressure on index multiples, which is already higher than past average. And on growth expectations, both the LDP and Nippon Ishin parties advocate market-friendly policies. Prime Minister Takaichi-san has also shown a willingness to incorporate opposition proposals that align with her policy direction. This balanced approach to fiscal expansion could boost growth expectations. And on cost of capital, Takaichi-san has previously expressed support for taxing retained earnings in her 2021 book, titled as Toward a Beautiful, Strong and Growing Nation. And in last year's LDP leadership race, she also called for revisions to the corporate governance code to encourage Japanese corporates to make better use of their cash reserves as well. And I think her appointment as Japan's first female prime minister may also help reduce Japan's ESG risk premium as well. So taken together, these factors suggest a long-term expansion in Japanese equity multiples. That said, market focus is now shifting toward US macro data and Japan's corporate earnings as well. And during our early October marketing trip to Hong Kong and Singapore, investors shared bullish views on the US, such as US auto sales remain strong despite tariffs. And if holiday sales don't disappoint, inventory restocking pressure could rise. And many investors also saw the near-term risk balance for dollar yen as skewed to the upside. So despite narrowing US and Japan rate differentials, dollar yen has remained firm. Why? One reason is that the US economy, while slowing, remains resilient, keeping terminal rate expectations near 3%, which is equivalent to the neutral rate. And another is the low volatility in data yen, which has encouraged leverage funds to increase short yen positioning on and supporting the data yen. And some investors believe that if the BOJ skips a rate hike at next week October meeting, leverage funds may further increase yen short positioning, potentially pushing data yen even higher. And I think this wouldn't necessarily be negative for the upcoming earnings season. I expect more upward revisions to company guidance than usual in this earnings season for two reasons. Number one is data yen has risen since first quarter earnings. We can remember in July, August, data yen hovered in the mid 140s. Now it's about 150. And this move supports upward revisions to corporate forecast. And number two is historically, about 25% corporates revise guidance upward during November result seasons. And in addition to that, in previous quarter, corporates were unusually cautious with the lowest revision rate in a decade. So I think many Japanese corporates that held off in first quarter may now revise upward. Additionally, I think uncertainty around the US tariff has eased right now, further supporting guidance upgrades. So taking all this into account, I believe the overall market sentiment is shooting toward optimism, except for stocks like AI-related names, where earnings expectations remain high and severe. So which stocks should we focus on going forward? I like to share my screen, and I published my last week's short-time note. I screened some stocks in this exhibit 17. So we're paying close attention to names highlighted in this chart 17, large cap, highly liquid stocks with weak price momentum but strong earnings revision, and rated overweight by our analyst. Recently, actually, some retail related stocks have seen sharp post-earnings rallies. So today's my message is that pay attention to these laggards that may be poised for relating. I'd like to stop here and pass back to Crystal.
Thank you very much, Shou. Before we take any questions, I would like to shift to the quant side. Simon published his factor rotation playbook, and then he's shifting he's mentioning that recently there's a factor rotation from growth to value APSJ. Can you talk about how does China differ from ex-China markets in terms of the strategies you would recommend?
Yeah, thank you, Crystal. Hi, everyone. We just published a note on recent market dynamics and our recommended quant strategies for Asia Pacific ex-Japan market. So the recent re-escalation of US-China trade tensions has triggered a clear risk of move in the APX3 market, leading to a sharp rotation from growth to value. However, when analyzing China and ex-China regions separately, we see that recent factor performance has diverged meaningfully. The recent growth to value rotation is primarily driven by China equities, while less related to the rest of the APX3 ex-China region. Since October the 10th, growth fell by over 4%, while value surged by around 11% in China as of this Monday. By contrast, in ex-China markets, growth is only slightly down by 0.2%, more resilient than value, which is down by almost 3%. On a year-to-date basis, growth has also been one of the standout factors in Asia. It is the best performer in China, up around 14%, and the second best performer ex-China, up around 13%. However, its strong performance has also led to rising valuation concerns. Growth stocks have become increasingly expensive in both China and ex-China markets, making it a risky factor across the whole region. It is also important to highlight that the significant divergence in return spreads between growth and value in China versus ex-China. In China, growth has outperformed the value by a big margin, with a spread of over 32%, even after the recent rotation from growth to value. In contrast, ex-China growth underperformed value, with a spread of negative 4%. This divergence underscores the need for having separate strategies for China and ex-China regions. For China, we suggest a balanced approach by combining value and composite momentum factors. Composite momentum includes price momentum, earnings revisions, and sales revisions. We believe this strategy allows us to participate in the value rally while hedging against potential volatilities with momentum exposure. We like value because it stands to benefit most if the growth correction continues. It is also highly correlated with quality, but offers a more defensive profile with higher correlation with low volatility and low beta factors. In terms of sector exposure, value is overweighting financials and energy sectors, which typically has more attractive valuations and also limited foreign revenue exposures. On the other hand, composite momentum is also appealing for its rebound potential if the trade tensions ease. It's also a seasonal strength during the earnings season, and also it is negatively correlated with value, which offers a natural hedge with value in the volatile environment. For ex-China region, we recommend focusing on earnings and sales revisions, which are better aligned with the current macro stream and offers a more dynamic way to capture the upside. So the key takeaway here is to maintain distinct strategies for China and the ex-China markets, given the ongoing uncertainty and the divergent factor performance. For China, combine value and composite momentum. For ex-China, stay long revisions. Finally, we also provide selected trade ideas based on our factor recommendations in our latest note. We also have a full list available for investors upon request. I will stop here. Back to you, Crystal.
Thank you so much, Simon. And last but not least, let me invite Calvin Pang here to talk about the recent note Asia credit. And then this note is about the Asia banks and lifers US dollar debt investments, and then what to expect next.
Yeah, sure. Thanks a lot, Crystal. I think if you look at post-Liberation Day, I think one of the key topics we have on the sort of fixed income side is more like what's the risk appetite for Asia banks and lifers towards dollar assets. So I think this is a very simple question, but it's actually not easy to answer because there's no good data about it. And the key takeaway from our report is that we come up with a framework, what we call the Asia dollar asset framework, that basically looks at disclosure of 51 Asia banks and lifers, and based on their BIS foreign claim plus US tick data, we have an estimate on how much of these total debt investment that Asia banks and lifer has, how much percentage of it is dollar asset. And we focus on 5 key countries, basically China, Japan, Hong Kong, Taiwan, and Singapore, because these, based on tick data, are the 5 largest holder of fixed income products in Asia. If you look at the bottom left chart, our estimate is by second quarter this year, Asia banks and lifers have about close to $3.3 trillion of debt investment. If you look at the table on the right, we can see that despite the differences, the homogeneity between different banks and lifers and different countries is actually quite huge. You have Chinese banks, for example, that has much lower concentration dollar risk compared to, let's say, Hong Kong banks, which has much higher dollar concentration risk. So if you look at the breakdown, you can notice that the whole Asia banks and lifers is not a monolithic group. They tend to vary, depends on the country they are and obviously the investor type they are. But overall, we notice is that 90% of the foreign currency books tend to be in US dollar. But if you look at the total debt investment, only 20 to 25% is in US dollar. So definitely, dollar is not the biggest part of their debt investment. And if you look at another perspective is, how big their role is in the US fixed income market. One thing we notice is that the three main allocation Asia banks and life has in the US fixed income markets are mainly Treasury, US agency, and US investment corporate bond. So you look at the bottom right chart, you can look at the breakdown, and what you notice is that US Treasury, allocations have been increasing. US investment grade saw the largest increase, and US agency is kind of flat versus what they had in fourth quarter 22. One thing we notice is that banks has been increasing allocation, but at the same time, lifers are actually reducing allocation due to the expensive dollar hedging costs. And if you look at the bottom of that chart, you can see that Asia banks and lifer basically holds about 10% of the US fixed income market. If you break it down into like Genie's US Treasury and US investment grade, they own about 7% of the US investment grade market, about 11% of the US Treasury market, and the highest about 14% of the Genius market. So I think the key takeaway from this slide is basically Asian banks and lifer plays quite a decent role. 10% of US fixed income market is definitely not small. So the size wise is definitely sizable and something that I think US investors tend to respect. I think in terms of what's going to change just allocations or what's the drivers of allocation. In the report, we go through 5 key catalysts. I'm not going to go through all of them, but I think I'll just pick 2. One, I think obviously dollar hedging cost is a big role for a lot of lifers in Asia as dollar hedging become cheaper due to the rate cuts that we are seeing from the Fed. We still are expecting another 4 to 5 rate cuts from the Fed from here that will help dollar hedging costs to be cheaper. That means Asia lifers will want to add dollar debt investment. I think the catalyst of cheaper dollar funding also means that could be higher supply for whether it's APEC IG bonds or whether it's higher demand for dollar loans that could also take away some of the demand for dollar debt investment. But overall, we do see that incrementally for Chinese and Japanese sort of banks, Japanese lifers, we do think that their incremental increase in dollar debt investment should increase from here, especially with the much lower starting point they have. I think lastly, just want to touch on just gentle read across US Treasury, US investment grade, and agency MBS. We do feel like for US agency MBS, demand from Chinese banks, Japanese banks will probably gradually return. And for Taiwanese bank, the increased exposure following the adoption of Basel III could also see some resurgence in demand. I think for US investment grade corporates, we think that cheaper dollar hedging yield will drive demand for USIG, and that could help support the current tight USIG spread valuation. I think for Treasury, we do think that the key takeaway is that so far we haven't seen active selling in by Asia banks and lifers. If you look at year to date, total dollar investment has actually increased about 3.2%. So I think overall, like we could see some incremental demand for Asia banks and lenders in the near term. I think that's the key takeaway. Why don't I stop here and pass back to Crystal?
Thank you, Calvin. And then now we are moving on to the Q&A session. The first one is for Sho on Japan. If the PM Takaichi-san were to call snap general election, when do you think will be the earliest realistic timing that we should expect?
Thank you for that question. Considering the political realities, the earliest plausible timing for snap general election under the Takaichi administration would be late December 2025. Specifically, the period immediately following the closure of the extraordinary diet session on December 17th through the end of the year is seen as a potential window for the snap general election. The current extraordinary session is scheduled to run for 58 days, ending on December 17th. So during this time, key parliamentary events are planned, including the Prime Minister Takaichi-san's policy speech, party leader Q&A sessions on early November, and the formulation of economic measures focused on addressing inflation. So these measures include a supplementary budget that incorporates policies such as the abolition of the provisional gasoline and diesel tax rates and support for medical and nursing care facilities as well. So for the Takaichi administration, passing this supplementary budget is a kind of top priority as it to demonstrate tangible policy achievements. And given the administration's fragile position, lacking a single party majority, I think it is crucial to first secure cooperation from parties like Nippon Ishin and build public trust through legislative success. So given these factors, I think it is unlikely that Takaichi-san will dissolve the diet before the supplementary budget is passed. So a more realistic scenario would be to delay any decision on dissolution the diet after the economic package and budget are approved, allowing the administration to showcase its accomplishments before heading into election.
Great, that's super clear. Thank you, Sho. And then another question is for Calvin. There have been recently there are a lot of credit quality concerns in the U.S. So do you think it will have any spillovers to Asia credit?
Yeah, thanks so much, Crystal. I think for now, if we look at on the US side, whether it's Tricor and First Brand, we do think that these still tend to be a bit more idiosyncratic and more limited towards individual name or idiosyncratic risk. So I think so far, I do think that the spill effect is limited. But that said, I think Asia credit spreads are really tight. So you look at Asia IG is the tightest ever at 63 basis points. So definitely the risk is for spread to be wider here. So far our view has been we want to be defensive here. We've been telling clients that single name or idiosyncratic risks pickup could increase here, especially if growth slow down or there's weakness in growth in the US. I think that would also cause some concern. But I think so far we don't think there's any of these contagion risks. But we do feel like even in Asia, investors need to be mindful of idiosyncratic risk, and definitely feel like investors should stick to higher quality names, given that the dispersion between higher quality and low quality, at least on the Asia side, is actually at historical high. Why don't I stop here?
Right. Thank you, Calvin. And then there is a question on the quant side as well. So recently, Mike Wilson has been calling for a tactical correction of 10 to 15% for US. How does it play into your factor strategy recommendation on the quant side in Asia?
Yeah, thank you, Crystal. So if that does happen, I think there will be another round of risk of a movement, and the current growth to value rotation will continue. In that case, value will be the biggest beneficiary at the expense of growth. I think our current value plus momentum approach is already well positioned to hedge the potential correction risks of the market. So I would say in China, the value and momentum strategy is a good hedge against the potential market corrections. Ex-China, in that case, I think the market will probably be behave similarly with another, given growth has been very expensive across the whole region. Any big market movements will present a high risk of growth. Yeah, thanks, Crystal.
Thank you, Simon. In the interest of time, we'll conclude today's podcast here and answer remaining questions offline. Thank you so much for joining us again, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.